gamer, and I broke down and invested in a serious graphics card about 3 months ago, forgetting that it doesn't have another connection for my second monitor, which normally would allow me to do split screen and all this really cool stuff. And 5 minutes before this talk, I'm trying to plug in things and realize, oh my God, there's no place to plug in my other monitor, so I can't do split screen. So this is going to be a little bit kludgy. You'll see me, you'll see my slides. I got to do this manually, right? So I apologize. It's my gaming addiction that did this. So this talk is about asking the question: can we tax the rich to fix the deficit? So let's start off by asking the question: does the government have a revenue problem? And what you're seeing here is federal revenue over from 1950 to the present. Nothing special about the years. This is all the data that's readily available. And what you see if you look at this, this is all federal tax revenues from all sources combined, right? We call this federal receipts. It means all the money combined. And what you see is that the revenue that the federal government's been collecting has been rising about 7% per year on average. You see some ups and downs from recessions, but generally speaking, the federal government, if you look at this thing, is awash in money compared to where it was 40, 50 years ago. Now, you might look at this and say, yeah, but that's not a fair discussion of federal revenue because prices have been rising over time as well. Okay, that's a fair criticism. Let's take these numbers and adjust them for inflation. And when you do that, you see this red graph. And what you see is even adjusted for inflation, the amount of money the federal government has been collecting over time has been rising. And you might even look at that and say, well, but that's not really a fair comparison either, because over time, the population grows. As the population grows, of course, you get more tax revenue. There's more people to tax. But, conversely, you also have to spend more on roads and bridges and police and schools and all that sort of thing. All right, so let's look at federal revenue, not just adjusted for inflation, but also adjusted for the number of people in the country. And when you do that, you see this. This is the green line. This is federal revenue per person adjusted for inflation. So to put that in kind of real people language, in 1950, the federal government collected what today we would consider $2,800 per person. Today, the federal government collects almost $10,000 per person. So even adjusted for inflation, the federal government is collecting over 3 times on a per taxpayer basis what it collected back in 1950. So I look at that picture and I think, all right, we have a deficit or a debt problem. I suspect that this isn't being caused by revenue because the revenue has been flowing in beautifully. So let me throw that out as my first conclusion here. Fundamentally, the government doesn't have a revenue problem. Now, you might look at that and say, okay, well, it's fine, tax revenue's been rising, but it's not rising fast enough. To reduce the deficit, we're going to have to raise taxes. That raises 2 problems. The first problem is the government can't raise taxes. It can only raise tax rates. Taxes are what happens when you combine tax rates with the economy's response. So if the government raises taxes, the economy slows down a bit. And when you combine that raising the taxes with the slowing down of the economy, what you're left with is the actual taxes the government collects. So to start with, this thing that politicians will say about should we raise taxes, should we lower taxes, is actually nonsense. They have no control over taxes. They can only control tax rates. The second problem with this idea of, well, we should just raise taxes is what's known as informally as Hausers law. And let me show you the most interesting, boring graph I've ever seen, right? So you look at this thing and it's boring. What's incredibly interesting about this is that the graph is boring. What you're seeing is federal receipts, all the federal government's taxes combined, as a percentage of GDP. And if you look at this goes back to 1950, right? It fluctuates a bit, sometimes up, sometimes down, but basically the line is flat. Or in other words, from 1950 to the present, the federal government has collected pretty constantly 17% of the economy. So if you imagine the economy as a pie, 17% is the slice the federal government collects. Now here's where life gets even more interesting. Superimposed on top of this the top marginal income tax rate. So you talk about taxing the rich, that's this red line that you see here. Back in the 1950s, we taxed the rich. The top marginal rate was very high. It comes down, it goes back up a little bit, right? That's what you see here. But now check this out. In the years when the top marginal income tax rate was particularly high, the federal government collected 17% of the economy's GDP. In years in which the top marginal income tax rate was particularly low, the federal government again collected about 17% of the economy. So the moral of this story is it appears that it doesn't matter whether you tax the rich a lot or a little, you end up with the same 17% slice of the economic pie. This is not just true of the top marginal income tax rate. It's also true of capital gains tax rates. So this is the tax that you're charged if you, for example, buy Apple stock at $100 a share and turn around and sell it at $150. That's capital gains, and you're taxed the capital gains tax rate. That's what you see here. In years when it was particularly high, the federal government collected 17% of the economy as its tax revenue. In years when it was particularly low, again, the federal government collected 17% of the economy. Same story with the effective corporate tax rate. When we tax corporations a lot, the federal government collects about 17% of the economy as tax revenue. When we tax them a little bit, the federal government collects about 17% of the economy. So this brings me to this second conclusion. Changes in tax rates apparently have no effect on tax revenue, at least not as a fraction of GDP, the size of the economy. Now, you might look at that and say, all right, well, that's fine, but this business revenue per GDP sounds a bit dodgy. Tell me about straight up tax revenue. What happens to the dollars that the government collects as tax rates change? All right, so let me show you that. What I'm going to show you here is a graph. Across the horizontal, you see the top marginal income tax rate. So moving to the right, that means that we're going to raise taxes on the rich. So further to the right is higher taxes on the rich, to the left is lower taxes on the rich. Up and down, we're going to measure tax revenue per person, and it's adjusted for inflation. So up means more tax revenue. Oh, and by the way, we're going to look at tax revenue 1 year later. So give whatever the tax rate that we impose, give it a year for it to take effect, right? And so let's see what happens to tax revenues 1 year later. So further up the chart you go, that's higher tax revenues. Further down the chart, that's less tax revenues. Now, the story that you hear is, well, we need to tax the rich to balance the budget. That's the conventional wisdom, and the conventional wisdom suggests that the data looks like this, right? Moving to the right, as you tax the rich more, your dots also go up. That is, you collect more tax revenue. Now, that's not the actual data. That's the story that you're told of what the data should look like. Now, let me show you the actual data. In reality, now there are exceptions, but in reality, from 1940 to the present, on average, as we have increased the tax rate on the richest Americans, we have actually collected less tax revenue on a per-person basis and adjusted for inflation. And it's not just true when you look at the top marginal income tax rate. It's also true if you look at the capital gains tax rate. Now, granted, the dots aren't as tight here as they were in the previous graph, but they still display this disturbing trend. They go down instead of up. The up is what you would expect. Here's the corporate profits tax rate. This is much tighter and, interestingly, more steep. That is, as we raise the corporate tax rate, the tax revenues that we collect decline dramatically. This is the estate tax rate, so taxes on things that rich people leave to their heirs. Same kind of thing. Raise the estate tax rate. A year later, you end up collecting less tax revenue on a per-person inflation-adjusted basis. So this would lead me to this conclusion. It seems that increasing tax rates actually results in a decline in tax revenue. But it's not true for all taxes. Turns out there are some taxes that behave the way that we would think they should behave. The two most important are Social Security and Medicare. This is Social Security and Medicare tax rates. As you move to the right, those taxes rates are going up, and up and down is the tax revenue. So on average, as we have increased the Social Security and Medicare tax rates, the federal government has collected more tax revenue. Now, what's the problem with the picture? The problem with the picture is we came here to talk about taxing the rich. Largely, the rich don't pay these taxes, which leads me to a little caveat on this conclusion 3. Increasing a tax rate tends to result in a decline in tax revenue. unless you're taxing the working class. When you tax the working class, all of a sudden the data turns around and you do get more tax revenue from raising tax rates. I'll come back to this point in a minute, but it's worth noting here that of all the taxes, I've looked at a whole bunch of federal taxes, of all the taxes, when you raise them, you actually get less tax revenue unless it's a tax that is not falling on the rich. So you might say, okay, enough of this nonsense. The problem simply is the rich aren't paying their fair share. That's worth talking about, but you've got to start the conversation with the question, what's fair, right? So here I'll show you some examples. This is data from 2014. This is the latest year that's available. You see the poorest 20% of Americans, that's on the top row. Their market income means income that they received from participation in the workforce, right? So it's not, it is wage income, interest income, that kind of thing. It's not handouts from the government. It's strictly money that they've earned in the marketplace. So the poorest 20% of households in the U.S. earn, on average, some more, some less, but on average they earn $8,000. The next 20% earn 31. The middle 20%, so that's straight up middle income Americans. The average household income there is about $55,000, and it goes up. You see the top 1%. The average household income amongst the top 1% is almost $1.5 million. Now, I've shown this to many groups of students and asked them, what do you think a fair tax rate is? And when I say tax rate, I mean effective tax rate. Here's what effective tax rate means. After you impose the taxes and the taxpayer goes through all of the business of, hiring accountants and doing write-offs and exemptions and deferrals and all that stuff that you do all of that stuff and let the dust settle. When the dust is settled, how much at the end of the day have you paid? That's an effective tax rate. So I ask many students, if you look at these groups of taxpayers, what would you say is a fair effective tax rate? The answers I get, of course, varies. If I get a room full of libertarian type students, everybody says 0, right? Yeah. Some others, I get more leftist type students who will give me, highly progressive numbers. I get more conservative students who give me less, more flat numbers. But the numbers that I tend to get of the progressive variety tend to look like this. Usually students say something like, the poorest 20% of Americans should only pay 5% of their income. The next 20% should pay 10%, the middle income Americans should pay 15%, and then when you get to the top 1%, they should be paying 30%. Now, you can argue whether you personally believe this is fair or not fair, but what I'm showing you is what the vast majority of students I've asked have identified as being fair. Now, keep your eyes on the fair effective tax rate, and let me show you what people actually pay. What you notice here is the amount of taxes that Americans actually pay. And remember, this is not the statutory tax, it's the effective tax, after you do all your deductions and exemptions and all that. The tax rates that Americans actually pay are more progressive than what people consider fair. That is, the top 1% are paying about what people consider to be fair. But as you go down the line, the next 20%, the middle 20%, the poorest 20%, they tend on average to be paying a lower tax rate than what people consider fair. But this isn't the end of the story. There's a thing called negative taxes. And negative taxes they're just like taxes, but instead of the government taking money from you, the government hands it to you. Right? This is not a tax rebate, right? A tax rebate means that you accidentally paid too much taxes and the IRS is going to square up with you at the end of the year. That's not what this is. This is the government actually cutting you a check. Income after transfers is your market income, the amount of money that you earned, doing your job or whatever it is that you do, plus the money that the government gives you free and for nothing. So combine those two things together, you get income after transfers. So transfers are exactly like taxes, except instead of the money going from you to the government, it goes from the government to you. Now, if you include transfers in your calculation of how much taxes people pay, you get a story that looks like this. The poorest 20% of households earn, on average, about $8,000 a year, and they receive from the government $17,000 per year. This is not food stamps. This is not housing allowance. This is a straight up cash. It's a check from the government. They earn $8,000. They receive a check from the government for about $17,000. Middle-income Americans, the average household in middle-income America earns about $55,000, and they actually get back from the government $11,000. So when you account for the amount of money these households pay in taxes, and you account for the money they get back in transfers, the amount of the effective tax rate that these households actually pay looks like this. The poorest 20% have a negative 200% tax rate. The next 20% have a negative 35% tax rate. Look at middle-income Americans. They've got a negative 7% tax rate. That is, if you look at these numbers, now there are exceptions, remember, these are just on average. But on average, it's only the top 20% who are net payers. And this becomes rather interesting because every time we talk about tax cuts, the thing you hear back is, well, tax cuts are just tax cuts for the rich. And that's true. It's almost true by definition because according to this is the Congressional Budget Office's own numbers, on average, it's only the top 20% who are paying. So if you cut taxes, by definition, you're cutting taxes on the rich. For comparison, those are the tax rates that people largely claim are fair. All right, so my conclusion here is, well, look, the rich are already paying their fair share, largely, and it's actually, if you want to talk about fairness, it's the poor and the middle class who aren't paying their fair share after you consider the transfers they receive back. To that, you might respond, all right, fine. But the fact is the rich are getting richer and the poor are getting poorer, and maybe because of that, we need to just forget this business about, you know, that the poor are getting more money back from the government. That's proper, and it's good because the rich are getting richer, the poor are getting poorer. Let me show you some data on that. What you're looking at here is U.S. households according to income. This is all adjusted for inflation. So the bars, the vertical bar is not household income. Household income is left to right. So the poor households are on the left, the rich households are on the right. The vertical bar is what percentage of U.S. households fall into that category. So over there on the left, you see households earning under $15,000. And back in 1970, about 15% of U.S. households were in that category. In the middle, that tallest bar, that's households earning $50,000 to $75,000. In 1970, almost a quarter, 25% of U.S. households were earning between $50,000 and $75,000. Now that's 1970. And remember, these numbers are adjusted for inflation, right? 1970. Now let's go forward a decade. Here's 1980. You can see the number of households earning under $15,000 has kind of shrunk a bit. Those middle-income households, $50,000 to $75,000, they've shrunk a bit as well. We got a little bit more over on the right, the richer households. That's 1980. Here's 1990. Here's 2000. And here's 2010. Now, as you look at this pattern. If you look at the poorest households, oh, sorry, 2013, forgot that. Here's the poorest households. Over this period, they've been declining. The number of poor households in the U.S. has been declining. Here's middle-income households. They're largely declining as well. We talk about the middle class disappearing. It is. That's what you see right here. Not only is the middle class disappearing, but the poor are disappearing also. Where have they gone? Largely, they've gone there. Americans adjusted for inflation. Of course, there are exceptions. There are some people who are drastically poorer than they were 10, 20 years ago. But on average, Americans are getting much richer. The poor are moving into the middle class are moving up into the rich, and largely this thing that you hear about the rich are getting richer and the poor are getting poorer is actually false. Most everybody is getting richer. So here's the bottom line. The rich, if you look at the data, are already paying their fair share. Now you might argue that 30% maybe isn't enough, maybe they should pay 50. Okay, that's fine, but what you cannot argue is that they're paying less than other income categories. They're paying by far the most. The poor and the middle class, however, are not. Now, you can argue whether or not the poor and middle class should be taxed more or taxed less, but the fact is, on average, the average poor and middle class household is actually receiving more money from the federal government than they're paying in. They aren't taxpayers at all. They're recipients. Third, the poor and the middle class are disappearing. They're joining the rich as time goes by. And then finally, the deficit problem that we end up with here actually isn't a revenue problem at all. It's a spending problem. Over time, the federal government has come awash in cash. It's got, on a per person basis and adjusted for inflation, 3.5 times as much as it did in the 1950s. So if we have a deficit problem, it's not caused by revenue, it's caused by the spending. All right, so I gave you a bunch of data to look at, and we can take a few minutes and ask some questions if I can figure out how to get my screen back here. Here we go. All right, have at it. Who has a question? I can't hear you, by the way.
Can you hear me now?
There we go. Now I can hear you.
All right, let's give an audible round of applause. Professor Davies. Fantastic as always, sir. So, who has a question? Can you hear me now?
There we go.
Man, we get that 20-second delay. All right, yes, Tim.
So just ask it out?
Yep, just shout it out there.
Would you agree there's a difference in the term of equality and equity?
Oh yeah, absolutely, absolutely. There's a difference between equality and equity. So equality, of course, everybody has the same thing, right? Equity is a much more elusive thing, right? What is fair? I'm glad you brought up the issue of inequality because I'm actually teed up for it. Now, how did I do this before? Hang on. There we go. Check this out. So let's talk about inequality for a moment. I have a big problem with inequality, and let me lay out for you what it is. We see children like this, and when we look at these children, what comes to many people's mind is inequality, that this is the ravages of inequality. And I'm telling you it's not. These children are suffering, but they are not suffering because they're unequal. They're suffering because they're poor. Inequality and poverty are not the same thing. To the extent that we focus continually on inequality, we run a real risk of missing a more important thing, and that is poverty. A good case in point, we talk about the 1% in this country. And we say it's not fair. The 1% have all this income, the rest of the 99% don't. Right now, because I can see you, put your hands up if you're in the 1%. I got one hand in the back. The rest of you are wrong. You're all in the 1%. If you earn $35,000 or more a year, come from a household that earns $35,000 or more in a year, you are in the top 1% on the planet. And that's adjusting for differences in costs of living across countries. Now, when we talk about the 1%, we draw this imaginary line on the map, and we only talk about the people inside the imaginary line. To the rest of the world, our talking about the inequality of the 1% to the rest of the world looks like the 9/10 of 1% complaining about the 1/10 of 1%. So the moral of the story is be very careful talking about inequality because there is a real problem here. Don't get me wrong. The real problem is not inequality. The real problem is poverty. Second, inequality doesn't necessarily measure what you think it does. Here's a bunch of people. Let's do a thought experiment. And I'll line them up from poorest to richest, right? So these people over here, they earn $100,000. The next group over earns $200,000, $300,000, and then the people on the right earn $400,000. So you look at this and you see lots of inequality. Let's suppose that these people actually are people at different stages of their careers. So the people on the left, they're people who just entered the workforce. They're earning, lower pay. The people in the middle two circles, they're at the mid-career. The people on the end, they've got a long career behind them. They're looking forward to retirement in the near future. And then behind these people, this is you. People who are preparing to enter the job market. Now again, you look at this picture and you see a lot of income inequality. But watch what happens when we move time forward. As we move time forward, each person passes through each of those four circles. so that each person over the course of his career earns exactly $1 million. In other words, in this thought experiment that you see here, there is always inequality, and yet everyone is perfectly equal. There's always inequality, and yet everyone is perfectly equal. The source of that apparent contradiction is the fact that when we talk about inequality, we take a snapshot, right? We look at people at one point in time, we see poor people, we see rich people. To really talk about inequality well, you have to look at people over the course of their entire lives. And then you can ask the question, who's equal, who's not equal? Next problem with inequality, this guy, Steve Jobs, right? So he dies with lots of money in the bank, and where does he get the money? He gets the money because people like this clip art woman give it to him. They give it to him in exchange for the iPhones. So the people who gave Steve Jobs money gave him the money because they liked his iPhones better than they liked the cash. But when we go to calculate inequality, the only thing we measure is the cash. We don't measure the iPhones. So our inequality measures right off or ignoring fully half of the economy. We're only looking at one half of the transactions, completely ignoring the benefit that people get from spending money on whatever it is they're spending money on. Last point on inequality, the two most equal countries on the planet, and this is measured by, if you know the Gini coefficient. Gini coefficient is one of the measures the economists use to measure inequality. So a low measure, a low Gini near zero means perfect equality. A high Gini 1.0 means perfect inequality. So the two most equal countries on the planet, Sweden and Afghanistan at 0.25 and 0.28. Those are the lowest Gini coefficients that exist currently. Now, if you look at these two countries, although they're both equal, the people are equal within the countries, the two countries are markedly different. Sweden's per capita income is about $54,000. Afghanistan's per capita income is about $600. In other words, the people in Sweden are equally rich. The people in Afghanistan are equally poor. But both countries enjoy a lot of equality. So my conclusion here, when you're talking about inequality, pay attention to these things. First off, inequality diverts our attention from a real problem. The real problem is poverty. Second, just because you see inequality at a point in time does not mean that you have inequality over time. Third, inequality ignores half the economy. It only looks at the accumulation of cash. It ignores the accumulation of goods and services. And then finally, equality at the end isn't even necessarily good. We can be equally miserable. So that's a very long-winded answer to your question. But I had the slide, so I had to show you. And your sound has gone away again.
Can you hear me now?
Yep.
Beautiful. All right. Questions for Professor Davies? Yes, Mike.
So Senator Cruz has proposed a new 10% flat tax on everyone. What do you think the impact of that would be on the American economy?
Can you repeat it a little bit closer to the microphone?
Yeah.
Okay. So the question, Professor Davies, was Ted Cruz has proposed a 10% flat tax as part of his presidential platform. What effect would this have on the economy?
Yeah, so generally speaking, I'm not endorsing Ted Cruz, but generally speaking, a flat tax is preferable. And the reason it's preferable is because a progressive tax discourages entrepreneurs, right? So think about someone like you, right? So you're in college, and when you graduate college, you go out and you get a job, and each of you will be facing an opportunity. You could take a risk, take out some extra loans on top of your student loans, start up a business because you've got some interesting idea, do all of that, right, and maybe employ some people, and understand there's a huge risk that it could blow up in your face and you go bankrupt and all of that, right? Or, alternatively, you just go work for somebody, right? And you get a nice little income, whatever it is, and low-risk situation. Now, here's the problem. When we have a progressive tax, that is, the more you earn, the higher the tax rate, we send a signal to would-be entrepreneurs, and that signal's perverse. It says, if you take a risk and it blows up in your face, that's just too bad for you. You're going to have to live with it. But if you take a risk and it pays off, we're now going to triple your taxes. I'm not sure that's the kind of message we want to be sending. Or let me say it another way. It focuses on the wrong thing. We see the rich entrepreneur, and we say, well, we should tax him at 3 times the rate of everybody else. And we're forgetting the fact that that entrepreneur, in becoming an entrepreneur, has created a tremendous number of jobs. He's created goods and services that people like, all of that stuff. Is it worth it to us to forego the possibility of having all those things, the jobs, the goods, the services, in exchange for tripling the income on this one person? I don't know, right? So economists would, generally speaking, not all economists by any means, but generally speaking, are more accepting of a flat tax than they are a progressive one. Now, having said that, the federal government's spending so much money that 10% flat tax isn't going to do it, right? If you get rid of all taxes and just have an income tax, right, you're probably going to need something like, I'm guessing 30% flat tax if you want to balance the budget.
He cut it.
What was the issue?
We missed something for like 45 seconds. So if he could repeat.
Oh, okay. Professor Davies, can you hear me?
I can.
Okay. The last 45 seconds of what you said had a technical difficulty.
The last 45 seconds.
Yes.
Okay. So
and Professor Davies, we also had a question. Are you referring to a flat tax rate, like, to clarify?
Oh, yeah. So when we say flat tax, what we normally mean, this is one of these stupid things. Economists use terms in one way, and the rest of the world, real human beings, use them in another way, right? So there are 2 definitions here. When I was saying flat tax, I'm using it in the common sense, and this is the sense that Ted Cruz means. That is that everybody pays the same percentage. Right? In your economics textbooks, you will not see that described as a flat tax. You'll see it described as a proportional tax. In the economics books, a flat tax means everybody pays the same number of dollars. So you pay $10, I pay $10, everybody pays $10. That's what in your economics books is called a flat tax. You know, real human beings don't call that a flat tax. They call it a full tax, right? It's not at all popular.
Very good. Questions for Professor Davies?
Is that what he said in last? Can you repeat? Like, because he answered this question.
Oh, okay. Professor Davies, can you hear me?
Yep.
Okay. So I'm glad we clarified flat tax rates. About the last 45 seconds of what you said to answer the second question was cut off. Could you summarize the end of the previous answer you gave?
Yeah, so what was the previous question?
Ted Cruz.
It was Ted Cruz. What effects the flat tax going to have on the economy?
Yeah, generally speaking, a flat tax is good because it doesn't remove, but it mitigates the disincentive to work hard, right? What you don't want to do. If you look at the news, you'll see Bill Gates, you'll see Warren Buffett. Both of these guys get on the news and they say they're not paying enough taxes, they should be taxed more. Go for it. I have no problem taxing Bill Gates and Warren Buffett more money. What I do have a problem with is taxing Bill Gates more money when he was younger, Warren Buffett more money when he was younger, because when they were younger, they hadn't yet taken their chances. They hadn't yet started up their businesses. If back then, when Bill Gates was 20-some years old, we had a very progressive tax system, it would have given him less incentive to start up Microsoft. And if he hadn't started up Microsoft, we'd be absent all kinds of software, we'd be absent all sorts of jobs, right? So notice here that one of the good things about a flat tax is it does not send a signal to entrepreneurs not to take risks. A proportional tax does that. Progressive tax does that. It sends a signal to entrepreneurs that if you take a risk and you make good on it, we're going to tax you a lot more money.
Fantastic, thank you. Questions for Professor Davies? Saw your hand first. Yes.
Why increasing tax rates doesn't result in tax revenue.
Okay, did you hear that, Professor Davies?
So, can you repeat it?
Sure. Why, Clara? Why does
increasing tax rates does not increase tax revenue?
Okay. Why does increasing the tax rate not increase the tax revenue?
Yeah, that's a really good question, and I don't know the answer, but I can give you some things that I suspect contain the answer. One possibility is probably a mixture of these things, right? One possibility is a thing that economists call the Laffer curve, and the Laffer curve says that if you charge a 0% tax rate, you will get zero revenue. But if you charge a 100% tax rate, you will also get zero revenue because nobody's going to work, right? So there's this kind of inverse, curve that as you raise tax rates, you get more and more tax revenue up to some sweet spot. And once you pass that sweet spot, as you raise taxes more, your revenue declines. So it's possible that what's at work here is partially the Laffer curve. I'm not so sure about that. The answer that I think I like better is that Congress gives with one hand and takes away with the other. That when Congress passes a law to raise tax rates, it also turns around and writes into the tax code all sorts of loopholes that enable you to get around this. Right? So think about Warren Buffett as an example. He's the second or third richest person in the country. His annual wage income is $100,000. How does he get to be the richest person with a wage income of $100,000? Because he takes the bulk of his payment not as wages, but as stock options. Why does he do that? Because stock options are taxed differently than income is. So as Congress raises the income tax rate on the rich, and everybody applauds Congress and says, yes, you're taxing rich, this is a good thing, Congress, being rich themselves, will turn around and introduce ways to get around this tax. So what happens at the end is you see the tax rate going up, and yet because of these loopholes that Congress has put in, you get tax revenues actually declining. So at the end, the only people who are winning here are the tax accountants, who we pay to negotiate our way through these loopholes.
Very good, thank you. Questions for Professor Davies. We'll do Ryan and then Taylor.
So this is a kind of complicated question, but what do you think about the possibility of the government setting tax rates based on how the economy is doing? So for example, if the economy is doing well, the government increases the tax rates, and if the economy is doing bad, it decreases the tax rates to stimulate economic growth. What do you think about that?
Yeah, and that's a Keynesian argument, right? Now, I'm not a Keynesian by any means, but I'll say something in his defense. Keynes argued that when the economy is in expansion, you raise, cut government spending, or conversely, you raise the tax rates, right? And it cools the economy off. It gives you the opportunity to collect some more revenue. But when the economy is in expansion or in recession, you do the reverse, right? And politicians will only tell you half of the story. So when the economy is in recession, they'll quote Keynes and say we need to spend more money. But when it's an expansion, they won't quote Keynes, which he would be saying, you've got to cut spending, right? And the inverse argument goes with taxation. So is it a good idea? I don't think so, but it's certainly got some intellectual merit. The problem is Congress doesn't work that way. If you give this argument to Congress, Congress is going to nod and say, yes, it's a very good thing, and they will only pay attention to the rule when it comes to raising the tax rates. They'll ignore it when it comes to cutting them.
And from Taylor.
Yeah, so you said that as a general principle, increasing tax rates on the rich does not increase tax revenue, but now you just said that some of that may be due to the tax cuts that are put in at the same time. So is it the tax breaks that are put in at the same time. So if those tax breaks were not put in, isn't it possible that we would in fact see an increase in tax revenue?
Yeah, I believe that's so. And you saw it, Social Security and Medicare taxes. That's that one graph that as you raise the tax rate, the tax revenue actually went up. The reason that's happening is because those two taxes are incredibly hard to get around, right? There's no exemptions, deductions, write-offs, anything like that. You earn $1, you owe Social Security, Medicare tax on it. Now, if you're somebody who can get paid in stock options instead of wages, you can get around it. But the vast majority of people who are actually paying those taxes aren't rich enough to be paid in stock options. We're getting paid in regular wages. So I think you're correct that that if you could get around the loophole business, that you'd see very different data here. However, I'm wondering if that's kind of a unicorns and rainbow argument. And that's not to say that you didn't make a good argument. You did. But practically speaking, I can't see Congress doing that, because Congress's goal, the individual congressmen, their goal is to get elected, right? And they get elected kind of if they fulfill this odd contradiction of spending more money because people like that, but not raising our taxes because people don't like that, right? But raising taxes on the rich because we'd like to do that, but Congress is rich themselves, and plus the rich people contribute to their campaign chest, and we don't want to make them too mad, right? This kind of thing. So in some sense, voters by not being educated in how economics works, put politicians in the position of having to do this weirdness of, yes, I'll raise tax rates, and when you're not looking, I'm going to throw in these loopholes.
Great, thank you, sir. Hands in the audience. Yes, sir.
How would it affect the revenue if we just lowered the effective tax rates for every tax bracket while simultaneously getting rid of a majority of the loopholes?
I don't know that the problem is the liberals, right? I mean, I think we spend too much time as citizens fighting with each other. It's not a liberal versus conservative thing. It's the systemic thing that we have established a system that rewards ever-increasing government. If the system itself isn't changed, I don't know that changing the people involved is going to change matters much. And you kind of hear this, right? Because you'll go through 8 years of a Republican and 8 years of a Democrat, and the Republicans say, well, life is worse, and the Democrats say, no, we're doing the same thing you did, and then the reverse happens 8 years later, and you end up almost with a situation where both sides, the left and the right, are for big government. The difference between them is what that big government's going to spend on, right? Is it going to be military? Is it going to be social programs? But they're both big government. And I think that's due to the incentives involved more so than it is the individual people.
Thank you, sir. It's come to my attention that David said loopholes, not.
Terribly sorry. So I'm sorry, David. Could you repeat your question, because I went off on liberal conservative.
Oh, very good.
Yeah. No, my question was, how would it affect the revenue stream if we cut taxes, like the tax rates, on all brackets while simultaneously getting rid of a majority of the loopholes?
Yeah, that's a good question. I don't know the answer, but my strong suspicion, if you do it well, my strong suspicion is you'll get more tax revenue, not necessarily because of anything you did with tweaking the taxes, but rather because the simplification of the tax code itself reduces drag on the economy. So you'll tend to get a little more entrepreneurship, more investment in people investing in their businesses, employing more people. I think you'll see the economy pick up simply through a simplification of the tax code.
Great, thank you. Hands in the audience. Tim, it's all you.
Yeah. So what exactly do you advocate for that the government should do, and what are the impacts that would come out of those advocations you're advocating for?
Yeah, that's a good question. I think where taxes are concerned, I would advocate for the extreme. This straight up flat tax. Everybody, regardless of your income, pays a percentage, right? And to the extent possible, and understand that when you get down to the weeds, these things become complicated. But to the extent possible, remove all of this exemption deduction nonsense, right? That kind of an approach has the benefit of making sure that everyone has skin in the game, right? Right now, we've got this odd situation where, on average, 60% of the voters are net recipients of federal large debt. That is, in a democracy, more than 50% of the people financially benefit from larger government, right? That's, I hate the word unsustainable, but the one thing I've encountered like it's worthy of that word is that situation, right? That's an explosive thing. Now, you might say, well, yeah, but what do you do about, you know, the poor? We've got to do something about that. I think one of my favorite economists, Milton Friedman, had a good idea, and he called it negative income tax. And the way it worked is it was flat tax like I described, right, with an added twist. And the added twist is everybody receives from the government a check every year for a fixed amount. So, for example, and these numbers don't work, but I'm just going to throw them out as an example. For example, everybody pays 20% of their income. I don't care if you're a minimum wage worker or Bill Gates. Everyone pays 20% of their income. And everyone receives a check for $10,000 from the government. Everyone. Minimum wage worker, I don't care if you're Bill Gates. Everyone gets a check. Now, what's the point of this? The point is to assure a minimum standard of living. And to make this work, you've got to remove from your system the entire welfare state. So subsidized housing is gone, minimum wage is gone, national health is gone, all this stuff is gone. That $10,000 check is what covers all of that. If it's not enough, you make it more, you make it $20,000, everybody gets it. So the idea is everyone is guaranteed this amount of money adequate to sustain, you know, a minimum standard of living. And there's no fall-off point like we have now, where you work harder, you make a little bit more money, and now the government starts taking stuff away. Everybody gets it, from the poorest up to Bill Gates. And everybody pays the same 20%. So everyone has the same skin in the game. The poor person has as much cause to fear expanded government as the rich person does.
Fantastic, thank you. Questions for Professor Davies? Elijah.
So my question is, why do you think the media sensationalizes some of the misconceptions that you have tried to point out tonight?
Yeah, there's a couple reasons for this. One reason is, remember, the media is a business, and its business is selling eyeballs. Right? When it can get you to watch its thing, it can sell advertising that makes money for the media. So if it can show you something that is, you know, titillating and you know, moves you emotionally, this is good, right? So if I show a bunch of poor people and say, look, Hillary Clinton did this, or Ted Cruz did this, or whatever it is, right? I get you agitated, and so I get your eyeballs. So that's one possible answer. Another possible answer, the one I like probably even better, is that economic truth requires more than a 10-second soundbite. In a 10-second soundbite, I can say, elect me and I'll raise the minimum wage. And I'll put more money in your pocket and you're going to be better off. And everybody applauds and says, yes, this is wonderful. But to explain to you the unemployment effects of a minimum wage, and more specifically how they really hurt most the people who most need our help, that requires more than a 10-second soundbite. And so when you're doing 10-second sound bites, you get predominantly economic falsehoods being proclaimed rather than economic truth.
Great, thank you. Ian Goodman.
Going back to your last answer to the last question about giving everybody a check, you know, for a certain amount of money, $15,000, $20,000, do you think that certain people would abuse that system and say, I don't have to work because no matter how much money I make, I have enough to live, the government's going to do that?
Yeah, so to an extent, yes. So some things we've got to be careful of. That amount of money that we give, whatever it is, 10,000, 20,000, whatever, it needs to truly be the minimum amount necessary, right? If we give everybody $70,000, we're going to have a lot of the effect that you described, of people just sitting back and saying, I'm not going to work, right? So in some sense, it has to simply cover the absolute bare necessities. not more than that. Will you still have people who will sit back and say, all right, well, it's a $20,000 check, you know what, I'd rather not work at all? Well, yeah, you are going to have some of those, but we have some of them now, right, under the current system. So I don't think there's any system that's going to eliminate that. What you have identified correctly is that there is going to be a trade-off. The trade-off between the level of guaranteed income we can provide people and the amount of disincentive to work that we're going to have to experience.
Follow-up to my
quick follow-up
question.
From
I was just wondering, on top of that, what do you think about giving the people who live in New York City a check for $20,000 and the people who live in, upstate Louisiana a check for $20,000? Just the cost of living and getting the same amount of money. How would that?
Yeah, you're absolutely right. There's practical problems involved. Do you adjust this thing for differences in cost of living? On the one hand, you could make what seems to be a reasonable argument that, well, the cost of living is more in New York, it's less somewhere else, so we should adjust for that. There's another also reasonable argument that says, well, then don't live in New York City, right? And I'm not quite sure where I fall on those two. The latter one of, well, just don't live in New York City has the benefit of making it very simple. Everybody gets a $20,000 check. But it doesn't seem right somehow, because there are going to be people who they can't afford to move, even on their $20,000. They can't get out of New York City. Meanwhile, there are people in Louisiana where, $20,000 will go a long way. The problem, of course, is how do you measure the differences in cost of living? That's not an exact science either, right? So what you're bumping up against here is the unfortunate economic truth that there is no right answer to any of this. There's simply more crappy and less crappy answers. You want to aim for the less crappy ones.
Well said. Tim.
Kind of touching on a couple of points I've addressed. Back kind of to the equality versus equity. When I was framing that earlier, I mean, equality is everyone gets the same thing. Equity is everyone gets what they need in order to be successful. And I think touching on the idea, although idealistic, to provide this amount, I know the health system, I had to spend over $1 million just to stay in a hospital just for those things. Where do we account for those things and provide it so everyone under the government, and which as a citizen we're supposed to be protected by our government, that we're actually ensuring that, and that it's not just me, someone of white privilege, that gets access to those things, but everybody across would get those, and that we're not just going to leave those people to die if it's more than their 20,000.
Yeah, that's a good question. I think the place to start is with the recognition of a hard reality, and that is, no matter how high we set this number, be it 10,000 or 20,000 or 50,000 or more, no matter how high we set it, there are going to be people who are left unable to buy to purchase the health care that they need, right? And if it's the guy with the cold, he can afford it. Maybe the guy with the broken leg can't, so we raise the money. And the guy with the broken leg can now afford it, but the guy with the heart defect can't, right? So we raise the money. The guy with the heart defect can afford it, but the guy who's going to be, 10 years of cancer treatments and so forth, he can't. So if we pursue this idea that everyone has got to be guaranteed the health care that they need, the right number is infinity. And of course, that's not possible. So that brings us back to, well, we've got to draw a line somewhere. And I don't have an answer for that, right? There isn't any answer that will satisfy everyone. I don't even think there's an answer that can satisfy the majority of people. So maybe when it comes to equity, maybe the answer lies in not relying on government at all. Because really, equity comes from, it requires a sense of, maybe equity is the wrong word, moral action requires free will. That is, I've got to be free to make my choices, to do my thing. If I choose to sell you this thing for $10 and you choose to buy it freely for $10, then by definition that's an equitable transaction because we both willingly agreed to it. And that's kind of the only place I can really point to that we can say objectively this is equitable. Other things, when you get the government involved and the government is forcing one person to do something, it immediately raises questions in my mind. Even if you like the outcome, it raises questions in my mind as to whether equity is even possible in that situation. And I don't know. We're as I'm sure you know, we're dancing around now questions of morality and philosophy that go beyond my training.
Good question, Tim. Questions for Professor Davies? Yes.
It seems like there's so the government spends too much money. So where else can the government get the revenues other than collecting taxes?
Where can the government get the revenue besides collecting taxes? Well, the short answer is nowhere. The federal government right now owes $19 trillion. That's just its official debt. On top of its official debt, the government has promised Social Security and Medicare benefits, and now it's promised health care benefits that it does not have the money to cover. And even if you account for future payroll taxes, it still won't have the money to cover. And if you add up the total amount of money the federal government has promised to people, senior citizens, retirees, and the money that it officially owes, that comes to around, and there are different estimates, right? But the more conservative estimates come in at around $100 to $120 trillion. Now, to put that in perspective, the federal government pays interest. The interest it pays on its debt is about 2.5%. 2.5% annual interest on $120 trillion roughly is the entire federal tax revenue. That is, the federal government is bankrupt right now. There is no place that it can go to get the money that it needs because there's simply not enough economic activity on the planet to fund, to make good on the promises our federal government has made.
Take about 3 more questions. So, 1, 2, 3. I might renege on that statement. We'll go with you.
So how do we reduce government spending while also still providing all the necessary things it needs in order to function, or all the necessary things that it's promised to people?
Yeah, it's a good question. First off, I tell you where the answer does not lie. The answer does not lie in cutting, military bases here, or don't build that aircraft carrier, or don't, shut down this social program, or whatever it is. Little things like that just snip around the edges, and they end up being irrelevant. I'll give you an example. A couple of years ago, in February, the president suggested cutting $300 million in community block grants. And there's a big to-do about this. People on one side saying, yes, we got to make these cuts because of budget deficits. People on the other side saying, no, you can't cut this. This is community block grants, or money that's going to the most needy Americans, right? $300 million. We talked about this as a country for about 6 weeks, right? It was in the news, back and forth. The federal government spends $300 million every 45 minutes. It literally cost us more to talk about the problem than what the solution was ever going to be worth. So discussions about cutting this or cutting that, I think, starts off on the wrong foot. You're never going to get the answer that way. I think the right way to get the answer is to step back and ask, what is the appropriate role of government in society? In other words, wipe the slate clean and then start putting things back in. Say, yes, government should do this, yes, government should do that. I think if you do that, and if you do it carefully, you can end up in what I think is a much better situation. And the better situation invokes, there's a term, subsidiarity. Subsidiarity means pushing government function to the lowest possible level. If the local government can do it, the state should not. If the state can do it, the federal government should not. That's the opposite way of doing government than what we're used to. We're used to seeing a problem and immediately going to Washington and asking the federal government to fix it. That's the upside down. That's the opposite of subsidiarity. If we actually practice subsidiarity, so push all of this government stuff that we do, push it down to the lowest possible level, I think you would end up in a world in which the federal government did very little. It had a military, it had a system of uniform justice, and that's about it. The states would do much of, when things we think about Social Security, Medicare, health insurance, these kinds of things would be done at a state level, some of them possibly even a local level. What's the benefit of that? The benefit is, all of a sudden, instead of having a governmental monopoly, that is one governmental entity imposing a solution on everybody, you have a bunch of experiments. Some of the states, some of the cities will do it right, others will do it wrong. The ones that do it wrong will learn from the ones that do it right. And so over time, we'll get the same wonderful competitive forces that make our industry, our marketplace so wonderful and so vibrant. You'll get that on a political level. Currently, we don't have it on a political level because we have politically a monopoly. So I think the right answer lies down that path.
Excellent. You in the back. What's your name?
Oh, me?
Yeah, you.
Sarah.
Hi, Sarah.
So just like on this idea of equitability, I was just wondering, wouldn't by the government cutting subsidies that are necessary for many people like healthcare actually like lead to more equitability because it stimulates economic activity and gives people more of a chance to get these wages that they need to earn to be able to afford this healthcare?
Can you repeat for me? That sounded like an interesting question.
Yeah, so I'm going to try and paraphrase it. You tell me if that's what you said. On the topic of cutting subsidies like healthcare for individual people, wouldn't that make things less equitable because, therefore, if you're cutting the subsidy, the people don't have enough money, they won't be able to stimulate growth? Is that?
Well, I was actually wondering if by subsidizing healthcare, it would lead to more people being able to afford it in the first place because it stimulates economic activity and gives many people a chance to be able to afford this healthcare.
Yeah. So is she asking is your point that subsidization of healthcare actually leads to higher healthcare prices?
No, taking away subsidies for healthcare increases the prices. Is the question increases?
Right. No, it's actually the reverse. When you subsidize something, you end up with higher prices. You all are experiencing this right now. Part of the reason, not all the reason by any means, but part of the reason that higher education, colleges are so expensive is because the government subsidizes them, right? And you can watch this. When the government increases subsidization of higher education, let's say, they come out with, students now get $1,000 extra Pell Grants or whatever it is they used to do, what you'll see very shortly is tuitions going up by that same amount.
Okay. Professor Davies, I think we still have a miscommunication on the question because of volume. So we have brought Sarah up to the front of the room to answer the question. Yes.
Hi, Sarah.
Hi. So I was just wondering if there's a correlation between the government subsidizing necessities like healthcare, if there's a correlation between that and the number of people that need this benefit.
That need it?
Yeah, can afford this benefit. So.
Okay, tell me. Give me an example.
Like, there's, like, when you talk about a correlation between tax rates and, economic activity and people who are living below the poverty line, I'm just wondering if by reducing, in many areas, government spending, by doing that, will give people more of an opportunity to pull themselves out of poverty and therefore subsidize it for themselves, like healthcare.
I see. So in other words, all right, let me make sure I get this right. So are you saying that if we subsidize healthcare, it makes people better off enough that they now can improve their own lives and pull themselves up out of whatever poverty they might find themselves in, that kind of thing?
No, it's okay.
Okay.
Sarah, can I try and paraphrase for you?
Yeah.
All right, we're gonna have Tim try to paraphrase.
I've got it, John.
All right.
So if you remove subsidies, would people then, in the difference of wages increasing, be able to afford healthcare on their own?
That is the question.
Okay. If we remove subsidies, will people be able to support healthcare on their own? Yeah. I think the answer is no, but I think it would help. The one of the things that happened when we looked at healthcare, we saw the increasing price. We turned to government. We said, do something. I think that was the wrong thing. What we should have done, at least as a first step, is to turn to the government and say, what are you doing that you could stop doing that's contributing? Subsidization is one. I think there's a bigger factor at play. In my opinion, the bigger factor at play, at least in this example, is that states would and they probably still do to an extent, restricted competition across state lines. So I'm in Pennsylvania. Insurers in Pennsylvania could not sell insurance outside of Pennsylvania, and vice versa. Insurers in New York State could not sell insurance in Pennsylvania. Now, if you're a very big insurer, you can get around this, but the smaller ones couldn't. What's the point of the law? Well, what you hear is consumer safety and all this stuff. What was really going on is that the big insurance companies wanted to draw a line around them and create a monopoly. That is, we're not going to let other insurers come into Pennsylvania and compete with us. And so that did what you would imagine. Anytime you restrict competition, you now get prices going up. That's one thing that happened. This happened not at the federal level, at the state level. Another thing the states did is they started requiring insurance to cover all sorts of things, right? So, insurance has got to cover dental care, insurance has got to cover, eye care, whatever it is. Every time the law requires that insurance covers something, of course, the cost of the insurance goes up. It raises an interesting question. Why were the states doing this? They were doing it because, for example, the dentists would get together and lobby the state government to require that dental work be covered on insurance. This was good for them, right? So the state passes this law, and now the insurance becomes more expensive. So the bottom line here is that I don't know that it's all by any means, but I think it's a significant chunk of the increase in the cost of health insurance was due to states erecting anti-competitive barriers and requiring that insurance cover things that people might not want covered. So that's a long-winded way of saying, yes, Sarah, I think you're right. Your sound is gone again.
If you haven't written your name and email down, just keep passing that around. Ryan, you had a question.
Yeah. Actually, I've got a second one now. This is off topic from taxes, but kind of going off of what you're talking about with healthcare. What role do you think price discrimination plays with pharmaceutical drug prices being so high in our country? With other countries putting price control on their drugs, are prices going up over here because of that? It's off topic for tax, but I was just curious about that.
Yeah, that's a complicated thing. There's lots of factors in play here. One goes back to the government restricting competition. And in this case, it restricts competition through patent law. So I can come up with some drug and I can patent it, and the government gives me monopoly protection for this thing. Now, we can argue whether patents are good or bad, and there are pluses and minuses here, but it doesn't change the fact that the government has created a monopoly, right? So that's one thing that's one factor it's playing. There's another thing here that's worth discussing that people tend not to talk about too much, and that is we look at the rising cost of healthcare, the rising cost of pharmaceuticals, and we forget that despite the rising cost of healthcare, despite the fact that healthcare is more expensive, despite the fact that pharmaceuticals are more expensive, if you ask the average American hands down would rather have today's medical technology at today's prices than to have 1950s medical technology at 1950s prices. That is, the value that we're receiving is commensurately higher as well. That's not to say that medical stuff isn't expensive. Certainly it is. But the value of what we're receiving is much better. I give you one statistic I know. If we had today in the U.S. the same mortality rate as we had in 1950, there would be about 1 million more Americans dying annually than are dying now. That is one of the things, at least if you count mortality rates, one of the things that the higher cost of healthcare and pharmaceuticals has given us is it has saved 1 million lives a year. So the take-home message here is be a little bit cautious when we talk about rising costs as being universally bad. Sometimes they're actually indicative of something that's quite good. And the good thing is that people like way better this thing they're getting now than the thing they used to get before at the lower price. Your sound is gone again.
I'm sorry.
Here we
Maybe
are.
everybody's quiet.
Okay. Actually, real quick, just I know people have got to head out soon, so I want to make a quick announcement for the club. If you are leaving, thank you so much for coming. In the middle of April, the week of April 11th, through that week, we're going to launch Freedom Week. And that's going to be a week devoted to freedom of expression and free speech. We'll have
Free speech ball.
We're going to have a free speech ball, giant 12-foot beach ball right in the middle of the quad that you all can sign. On Tuesday, we're going to have a policy debate between all the political clubs on campus. And then on Wednesday, we are going to be screening the world premiere of Can We Take a Joke?, which talks about the intersection between free speech, microaggressions on college campuses, and stand-up comedy. So we would love to see you all there. I just want to get that out in case people have to go do academic things, quote unquote. But Ryan, your question.
Oh yeah. So my other question, which is related to taxes now, is what do you think the impact of some of the things that Bernie Sanders has proposed doing to the tax code? What impact would that have on the economy? Such as like almost tripling the capital gains, increasing the marginal tax rate on the top 1%, stuff like that. What do you think that'll do to the economy?
Yeah, so I think the thing to keep in mind is anytime you tax something, you're going to get less of it. So we could talk about taxing capital gains more, but understand that what we'll get less of is we'll get less investment. And if we get less investment, you know, that's not going to hurt us too much right now, but 10 years from now, 20 years from now, there will be companies that don't exist and jobs that don't exist that would have otherwise if the investment had occurred, you know, today. So I think when you picture raising capital gains tax rates, keep in mind the trade-off. The plus you're getting, you know, if you can get it, is increased tax revenue today. But it's coming at the expense of fewer jobs, fewer companies, fewer products 10, 20 years down the road because you have reduced investment, right? And, you know, same thing with, you know, taxing the rich. If you tax the rich more, you know, the people who are rich today will pay more, that's fine, but you'll see fewer entrepreneurs. You'll see fewer people taking risks to get rich because we have raised the cost of becoming rich. And that means less jobs, less products, less, you know, companies in the future.
Beautiful. Have we any more questions for Professor Davies? All right, well, let's give him another audible round of applause. Professor, it's great to have your perspective brought to Ithaca College. We don't often hear this narrative of economics, so we really appreciate you having here. Thank you.
My pleasure. Thank you.
Garrett, do you have any announcements?
Not quite, besides the fact that we have one more state convention in the Northeast region on April 30th at Brown University. We have one of our state conventions, and they're fantastic. We have great speakers, trainings, and it's just a great way to network. Besides coming to see us, there are other great sponsors if you're looking for possible internships or jobs. Again, Professor Davies, looks like he's gone. I was going to say thank you, but I really wish I could have him talk to my Facebook friends. So again, thank you guys for coming out. We'll go to yaliberty.org if you want to learn more about it. I'm sure Sean is a great, go straight to him if you need anything. So thanks for coming out, guys.
Great, thanks, Garrett.
Thank you, everyone.
Thanks, Jason. Cruz. All right, beautiful.